Income tax schemes, accounting periods, accounting methods, and reporting. Types of taxation schemes and their scope. 1. Proportional tax, flat tax. In this scheme, everyone pays the same percentage of their income, regardless of how much they earn. How it works: if the tax rate is 15%, a person earning $30,000 pays 15%, and a person earning $300,000 pays 15%. Scope: often applied to corporate taxes or specific state-level income taxes. 2. Progressive tax. This is the most common system for personal income tax in many modern economies. The tax rate increases as the taxable amount increases. How it works: it uses lax brackets. You might pay 10% on your first $10,000, 15% on the next $30,000, and so on. Scope: primary method for federal income tax, e.g., USA, UK, Canada. 3. Regressive tax. A tax that takes a larger percentage of income from low-income earners than from high-income earners. How it works: these are usually flat fees or consumption taxes. A $1 tax on a gallon of gas is a much larger chunk of a minimum wage worker's daily pay than it is for a billionaire's. Scope: sales tax, excise taxes, alcohol, tobacco, and tolls. Four. Specific scopes of taxation. Beyond how the rate is calculated, taxes are categorized by what is being taxed. Income tax, levied on wages, salaries, dividends, and interest. Capital gains tax, levied on the profit from the sale of an asset, like stocks or real estate. Property tax, based on the value of real estate owned. Ad valorem tax. A tax based on the assessed value of an item, e.g., VAT or sales tax. Excise tax, sin taxes or specific usage taxes, fuel, cigarettes, luxury goods. Comparison of taxation schemes. Progressive tax. Rate change: the tax rate increases as your income or taxable amount goes up. Impact: hits high-income earners hardest. Primary goal: to redistribute wealth and reduce economic inequality. Common example: federal income tax. Proportional, flat, tax. Rate change: the tax rate stays the same for everyone, regardless of income. Impact: hits the middle class and lower income earners relatively harder than the wealthy, as it takes a fixed chunk of essential spending money. Primary goal: simplicity and neutrality in the tax code. Common example: corporal tax or certain state income taxes. Regressive tax. Rate change: the effective rate decreases as income increases, because the tax is usually a flat fee on a product/service. Impact: hits low-income earners hardest. Primary goal: to generate revenue from consumption or discourage specific behaviors, like smoking. Common example: sales tax, gas tax, or sin taxes, alcohol/tobacco. Concept of accounting period and its type. Think of the accounting period as the performance review for a business. If a business just ran forever without stopping to check the numbers, the owners wouldn't know if they were actually making a profit or just spending their initial savings. By breaking the life of a business into specific time buckets, we can compare how this month performed against last month, or this year against last year. The three main types. Businesses usually pulse to one of these three rhythms. Calendar year: this is the standard 12-month cycle starting January 1st and ending December 31st. It's what most of us use for our personal lives and taxes. Fiscal year: this is still a 12-month period, but it starts whenever the business wants. For example, a school might start their year in July to match the academic calendar, or a giant retailer might end their year in January to capture all the holiday redeem data. Interim period, these are mini-chapters within a year. Most big companies do quarterly, every 3 months, or monthly reports. It's like a mid-season check-in to make sure the ship is still sailing in the right direction. Why do we bother? The main goal is consistency. By closing the books at the same time every period, you can see real trends. It's the difference between guessing you're successful and actually having the data to prove it to the bank, or yourself. Concept of accounting methods and their accounting procedures. Accounting methods are the sets of rules a business follows to determine when to report revenues and expenses. Choosing a method is a critical decision because it dictates how a company's financial health is presented to stakeholders and tax authorities. The two primary systems are accrual basis and cash basis accounting. 1. Accrual basis accounting. This is the standard for most medium to large businesses and is required by generally accepted accounting principles, GAAP. The concept, revenue is recorded when it is earned, and expenses are recorded when they are incurred, regardless of when the actual cash moves. The logic, it follows the matching principle, which ensures that the expenses used to generate revenue are recorded in the same reporting period. Accounting procedure. Revenue recognition, when a service is performed or a product is delivered, an invoice is created, and accounts receivable is debited. Expense recording, when a utility bill or vendor invoice arrives, it is recorded as an accounts payable even if it won't be paid until next month. Adjusting entries, at the end of the period, accountants must make entries for accruals, unpaid wages, and deferrals, prepaid insurance, to ensure the books reflect reality. Two. Cash basis accounting. This method is more common for small businesses, sole proprietorships, or individuals with simple financial structures. The concept, revenue is recorded only when cash is received, and expenses are recorded only when cash is paid. The logic, it tracks actual cash flow rather than obligations. It does not recognize accounts receivable or accounts payable. Accounting procedure. Recording receipts, income is entered into the ledger only once the check clears or the cash is in hand. Recording payments, expenses are recognized only at the moment the funds leave the bank account. Simplified closing, there is generally no need for complex adjusting entries for depreciation or bad debt, as only liquid movement matters. Types of tax returns, their deadline and place of filing in a table. Number 1. Annual Income Tax Return, Individuals. BR Form 1701/1701A. Deadline. On or before April 15th of the following year. Place of filing. EBR Forms, EFPS, Authorized Agent Bank, AAB, or BR RDO. Number 2. Quarterly Income Tax Return, Individuals. BR Form 17,010. Deadline. 45 days after the end of each quarter. Place of filing. EBR Forms, EFPS, AAB, or BR RDO. Number 3. Quarterly VAT Return. BR Form 25,500. Deadline. 25 days after the end of the quarter. Place of filing. EBR Forms, EFPS, or AAB. Number 4. Percentage Tax Return. BR Form 2551Q. Deadline. 25 days after the end of each quarter. Place of filing. EBR forms, EFPS, or AAB. Number 5. Expanded withholding tax, quarterly. EBR form 1601EQ. Deadline. Last day of the month following the quarter. Place of filing. EBR forms, EFPS, or AAB. Thank you for listening.